Louise Bedford here, the Money Chick and the host of the Talking Trading podcast. This is how traders excel. Have you felt that you've always been late to the party and you want to get into the best trades before the crowd? Or have you felt frustrated that you've been second guessing your trading decisions and you're after a consistently profitable result? These are some of the things that I'm going to talk about with Jason McIntosh. He runs Motion Trader. And if you've been a long time listener of the podcast, you will know that Jason and I are actually friends. He is one of the people that I turn to with new trading ideas or if I want to enter a new market, and we shoot the breeze. And I want you to listen to this man's wisdom. He trades in a similar but not completely the same way. So pick up on those similarities and those differences in this podcast. You're not going to believe how this will set you up for the trading year ahead. Jason McIntosh from Motion Trader, welcome to the show.
Louise, it is such a pleasure to be here. Thanks for having me on. I've been looking forward all week to coming on and having a chat about markets and trading with you.
Absolutely. Look, as I mentioned in our introduction, it is so lovely to have your friendship and to have a trading friend where I can talk about different concepts. I'm going to want you to share some of those ideas with the Talking Trading listeners because I always get so much out of it. So from 2024 to 2025, I would love to hear some of the things that you learned in 2024 and how can we set ourselves up for success in 2025?
Look, Louise, I think the biggest lesson of them all, it doesn't change. It doesn't change from year to year. It doesn't matter what the markets do. And that lesson is you have to have a process. That is key. That is king. You've got to have the process. You've got to have those set of guiding principles that help you make your decisions and take you through the trading cycle. And I think it's the people who have that good process that typically come out on top over time. And the reason for that is because no one knows where the market's going to go. We just don't know. We can have scenarios, we can have ideas and biases to what may happen, but we just don't know what's going to happen. And this is why the people with that structured process typically do best. And that's because they know what to do in every situation. The market goes up, they've got a plan. If it goes down or goes sideways, they've got a plan. And it's just a case then of following that plan through rather than trying to just wing it each and every time and throwing in a bit of gut feel and just hope for the best. It kind of doesn't really work out too well when you do that. And like if it's a difficult year, like it was in 2022, a good process might involve just pulling back risk. It might involve having fewer positions. And then we get a good year like we did in 2024, and a good process might help you just get out there and find those opportunities, take a bit more risk, let your profits run, maximising those gains and those stocks which tend to go. Now, you compare that to somebody who doesn't have a plan or who maybe only they've got part of a plan. Maybe they've got some ideas around when to buy, but portfolio structure and losses and when to get out of them, there's not too much going on there. And I find that when you don't have a plan, you tend to be more susceptible to making emotional decisions. You'll base things on what the headlines are, what your gut feel is. And this gets really stressful when things aren't going well. Trying to do things on the fly when emotions are high, it's a stressful period. And this is when I think we tend to get people who don't have those plans, they tend to get quite inconsistent results. I think a really good starting point each year, if you go back and you review how you went the previous year, what your portfolio did, I think a really good starting point is to just look at your portfolio and ask yourself, were my decisions, were they systematic or were they more influenced by things like tips, like gut feel, by emotional decision making? And I think if we want to make a habit of winning and doing well by outperforming the market, I think it's essential that we're systematic and we do take those emotions out and we are structured and we're planned.
Yeah, I agree. You're singing my song here. There's no doubt. I love it when people are following a written trading plan so that they're actually making sure there's consistency in their trading. And one of the things that I've loved, because you know that I get your newsletter and that I follow your newsletter to help with diversification, one of the things that I've loved over the past few years actually is that we're not just focusing on the large cap stocks. Actually, the biggest gains that I've had have not been in those large cap stocks. Could you give the listeners an idea about how they can detect those promising smaller cap stocks?
Yeah, this is fascinating. Like, I really love this part of the market, and that is that exactly as you say, Louise, many of the best performers are from outside the ASX 200. So let me just rattle off a few names that come to mind. So SKS Technologies, Orthocell, AI Media, Before Pay, and how about smart parking? So they're just a few that come to mind that have been really strong performers in 2024. But how many people have heard of them? Like, I'd heard of none of them prior to them turning up in my momentum scans. And this is just so typical of what happens every year. It's the same thing every year. Many of the best performers, in fact, I'd say most of the best performers, are from outside the household names. And those stocks I just mentioned, they're not 2 cent stocks or 5 cent stocks. They don't have market caps of $20 million. Generally, predominantly, they've got market caps of well north of $100 million. So they're small to medium sized businesses which are growing. And this is where some of the best gains really do come from. And so I think the big lesson is that a lot of money can be made outside of those household names. And those big stocks that we know, the big stocks in the ASX 50, the ASX 100, a lot of them started out as those small to mid-tier companies. Like, you take a company like JB Hi-Fi, for instance. So, been in the news recently. It's a big company. It's been doing really well. But you look back 20 years, JB Hi-Fi was once a $2 stock. It's now a $100 stock. And this is where a lot of money is made. It's made when those small to mid-tier stocks, they come through the ranks and they grow and they make their way into the ASX 300, they make their way into the ASX 200. But by the time most people seem to become aware of them, they've already had that significant growth phase. And sure, they may continue to do well and they pay dividends, but that really big outperformance tends to come at an earlier stage. Now, the problem a lot of people will have is that they'll say, look, there are 2,000 stocks. How on earth am I going to get myself across 2,000 stocks and find these names which I mentioned earlier? Like, how do you do that? And this is why people find themselves looking through the ASX 100, because they're familiar with the names. It narrows down the field. They take 2,000 stocks, focus on maybe 50 or 100 possibilities, and it just narrows the universe, makes it easier to choose. But I think if you're able to expand your field of vision, you open those opportunities. So I'm using momentum. Momentum is the key, I think, to unlocking a lot of these small to medium-sized companies, which you otherwise won't find. So I describe momentum as a bit like ripples in the water. So imagine dropping a stone into a still pond. You can quickly identify where the stones drop. You just follow the ripples back to the middle. I'm doing something similar with momentum with share price. So any stock that's going to go from $1 to $5, it doesn't just get there overnight. It's a process of the share price rising. And you can identify that momentum in the share price through scans and just simple indicators like breakouts and moving averages. So that's a big part of what I'm doing with identifying these stocks. And I did this morning. This was really interesting. I just had this idea this morning. I thought, how many stocks in the All Ordinaries are currently up by 100%? And I just opened up the top 500, ranked them from best performer down, counted them up. There were 50. So there were 50 of the top 500 stocks are up by over 100%. And then I went to my own portfolio. So I've got a portfolio made up of motion trader stocks in my motion trader personal portfolio. And I'm currently holding 42 stocks, and 11 of those are up by 100% or more. So that's a bit over a quarter. I think it was 26%. So there are two takeaways from this. So my portfolio, I don't have a single stock which is a household name. I hadn't heard of most of them before they'd turned up in the signals. And again, these aren't like penny stocks. They're not high risk speculative 1 cent mining shares. They're medium to small to medium businesses which are growing. And so none are a household name. You look at the big performers in the All Ordinaries, and more than half of them have a market cap of less than $1 billion. So that doesn't get most of them into the ASX 300. So you can see if you're looking at the ASX 50, it's pretty lean pickings for the 100% gains. And then the other takeaway from this is like, how is it that I've got an over-representation of 100% gains in my portfolio? So the ASX 500 or the All Ordinaries, 10% are up by 100% over the last year. My portfolio, it's not a perfect time match. I'm just looking at my portfolio generally. Some of the stocks I've held for a bit over a year, but nonetheless, there is that general over-representation of about a quarter of the stocks being up by that large amount. And the reason for that is that I'm cherry picking. I'm using the overall ASX as my starting point, and then I'm using momentum to narrow down the field and take out the parts which are working. And if a stock keeps working, I just keep holding it, and that's where those large gains become possible, because you let the winners run. And when it's not working, cut it, sell it, exit the portfolio, rotate the capital into something else. So
let's talk about that, because I think that is one of the balancing acts, getting into a variety of different stocks, making sure that your risk management is looked after so that you're not putting too much into any one position. But how do you build that large portfolio if you've got so many different stocks and you're trying to get out of the losers fairly quickly?
Yeah, look, I think if you want to have a profitable portfolio, you really have to control your losses. That is so important. It's the overriding focus for so many people. It's like, how much could I make in this stock? And sure, that's a big consideration, but what's, I think, more important, it's controlling your risk, controlling your losses. Every year, I hear from people who'll say, look, I've got my portfolio. I get upset every time I look at it because I've got this collection of stocks which are down 60, 70, 80%, sometimes more. And I've been holding them. I don't know what to do with them. Now seems too late to sell them. But this sort of situation, it's just so avoidable. And a good recent example is Star Entertainment. And that's a big stock. Well, it was a big stock. It's a household name stock, which has been in the news a lot lately, and it's down. If we go back to 2021, and that's not even its all-time high, but we'll use its interim peak in 2021. It's down 97% since then. That's over, say, a 3.5-year period. But of course, it didn't get there overnight. So listeners and viewers, they can go and call up a start of Star Entertainment, put on, say, a 50 and 100-day moving average. And you'll see that for the most part of the last 3 years, it's had a share price which has been declining below falling moving averages. So this has been a long process of unravelling. And what's interesting is people have been buying all the way down, because of course there's every sell each day someone's also buying. So people have been buying all the way down. So who's been buying? People have been trying to pick the lows. People have been trying to be average down. People have been holding and hoping. And it ends up with this disaster. So in terms of like building a portfolio and getting rid of stocks that aren't working, I think this is a key part. So we're all going to make mistakes, and we're going to get into stocks which don't do well. But I think if you keep repeating this mistake of holding on to stocks that are in decline, then it gets really hard to get ahead. So I think the big lesson that we can learn from that, Louise, it's just having that clear exit strategy. It's about thinking about what you could lose instead of just being solely focused on what you could make. Think about what if I'm wrong? What could I lose in this? And then preserving capital for new opportunities. And And people always tell me, they say, look, I don't want to use a stop loss because I'm concerned that the stop loss might trigger and I sell and then the shares recover. And I say to them that it's not the stocks that recover after you sell them that cause the problem for the portfolio. It's the stocks that you don't sell and continue to unravel. They're the ones that become the lead weight in the portfolio and really ruin returns. And it's okay to buy a stock that fails. If you're going to be in the stock market, you're going to buy lots of stocks that fail, and that's okay. But it's what I look at. It's like, if I'm going to fail, I want to fail early. I want to fail cheaply. So I want to cut losing stocks at an early stage. Louise, it's about playing great defence. It's not just about what you can win. Play that great defensive game first and then try and make money from there.
I love that. There's so much running through my head at the moment because you are definitely touching on some things that members of my mentor program would be familiar with. One of the pieces of the evidence that I'll corroborate this with is that we found, I know for your situation, you're using fixed position sizing, but if you're using a percent risk to position size, we found that 0.5% risk for your initial position actually outperforms if you're using 1%. 1% outperforms if you're using 2%, especially for systems that pyramid, because what you're looking at is getting more of a spread so that you can get those losers emerging very quickly and you can back those winners by throwing more money at them. So that's a separate piece of evidence compared to your data. This is one of the things too, Jason, is I feel that people don't look at the data. They don't look at the evidence. They go on gut feel. Whereas what you and I are doing is we're trying to be objective by looking at the data. It is hard sometimes though, because your emotions do run out of control. How do you avoid that feeling of greed and that feeling of, oh, I've got a winner here, I'm just going to be so set? How do you avoid that?
Well, I think it all comes back to the rules, is having that disciplined process. And you do need a level of greed when you're doing well, because it's that hope that the stock can continue to rise that helps you let a winning trade run. It's like we just talked about cutting losses, but the other area so many people struggle with is that they cut their winners too early. So we tend to see these portfolios where people let their losses run, but then on the other side of the ledger, they take their profits too soon. And just imagine a portfolio that does that. Let your losses run, cut your winners early. Of course it doesn't work. It's a disastrous portfolio, but this is how a lot of people do approach the market. It's what we've got to do. We've got to flip it. We've got to do the opposite. We've got to do what we were talking about earlier with just cutting losses, but then we've got to be able to have that process that lets us maximize our profits in stocks which are doing well and let those profits run, not take those profits too soon. And the reason people do that is they get a 10 or 20 or 30% profit and they say, look, I don't want to risk a pullback, so I'm just going to bank it. And they listen to those sayings like, you never go broke taking a profit, which is just awful advice, because you can go broke taking a profit. I can run a back test and statistically prove it that you can go broke taking a profit. If you're taking small profits and large losses, it's going to be a disaster. So, but this is, like you say, you've got to, I think it helps to look at the data. It helps testing, build confidence that letting profits run is the right thing to do. Do what's right, let profits run. And I think this is the core of building a framework for an outperforming portfolio, just having that basic understanding of, we want to keep our losses small, we want to make our profits large. One of last year's best performing stocks, a company called SKS Technologies, I mentioned it earlier, it was up something like 500% last year. Now, this was a completely gettable advance. And it's not just me saying that in hindsight, looking at a stock which is up 500%, saying, oh, I could have got that. It's because there were some big pullbacks along the way, but with a wide trailing stop, they were survivable. And I know this because it's one of the stocks in my own portfolio. It's a motion trader stock, and I bought it myself about about 12 months ago. So it's I think it's my best performing stock at the moment, up about, as I say, up about that 500%. So I know it was entirely gettable. But the key to getting that trade was, so there were a couple of really important parts about getting it. First was not to cap upside potential. Don't see a modest gain and go and lock it in. Let the profit run. Don't get in the way of something that's working. Let it keep working for as long as possible. Because big winners are uncommon. We saw that earlier on when I talked about the All Ordinaries. Only 10% of the All Ordinaries is up by 100% in the last year. So big winners are uncommon. They're not a rarity, but it's not the norm. And studies show this. And I'm sure you've seen these studies, Louise, which show that over time, the majority of stocks underperform. So that's why it's so important to maximise a winner when you get one. And then you manage that risk with a trailing stop. Because the other pitfall people fall for, like you get the people who sell too early, but then you get others who are really good at holding in there, and they might ride a stock up several 100%, but then they don't have the plan for selling. So then they ride it all the way back down to where they got in, and often I hear they ride it into loss. It's not an infrequent story. So that's where the trailing stop comes in. It lets the profit run, gives it lots of room to move around, but then it gives you your out, and that's a really important thing. You've got to be able to know when to sell at some point along the line.
Yeah. I find some of my traders find it difficult with time frames though, because what you're talking about here is having a fairly wide trailing stop so that you can allow room to wiggle and then hopefully then continue the primary trend. But once they get a day or two where it's going the wrong direction, it's almost like, oh, henny penny, the sky is falling in. So that can be a difficult tension within a trader. What are some of the other mistakes that you see your traders making?
What you just said then about the people struggle when they get a down day, this wide trailing stops is the area where I just get the most pushback from people, and they tell me that I use my trailing stops. They say, your trailing stops are too wide, they're too risky, I'm going to lose too much money, they don't work, I want to protect my profits, I want to set a trailing stop. Sure, I understand, let it run, but hey, 10% is more than enough to let it run. You're just wrong. You're wrong using a trailing stop which might be wider than 25%. But of course, I can do the back test, and I can show them. I can say, hey, okay, let's do 10% trailing stop. Let's see what happens. Let's run the back test. And those big trends, which might go 100, 200 or more percent, they're going to have, more often than not, almost always, they're going to have several pullbacks of, say, 15 to 30%. Now, how's your 10% stop looking? It's going to take you out on probably the first moderate pullback. It's not going to work. You're not going to get those big triple-digit gains. It's not possible. The only way you can get them, call up any chart of a stock that's gone up several 100%, and you're going to see those multitude of corrections along the way, which are wide enough to take just about every retail-orientated trader out who's trying to get a big gain, but is just really trying to cling on to every dollar of profit. They just can't stay on. They get bucked off the trend. That's what markets do. They make it difficult. They make it emotionally a struggle to stay on, and that's why it's hard.
And I think a nexus between, if you want the big profits, you have to be prepared to put up with the relatively big drawdown, because you can't have a very small drawdown with very large profits. It doesn't work over time on average. It might work for one share. You might be able to cherry pick the particular share that went from the bottom left-hand side to the top right-hand side with barely any pullback. But in general terms, that doesn't happen.
It's a myth. They don't. It doesn't work like that at all. Even the nicest, smoothest trending stock is still going to come back by probably at least 15 to 20% at some point. It doesn't work. I would love to use tight trailing stops in all my positions and have no drawdowns. I'd love it, Louise, but you don't think that if I could do it, I'd do it, but it doesn't work. So you got to do what works, do what's right. It's not what's easy. You're not trading individual shares because you're going to be comfortable all the time. You're trading individual shares because you're fascinated in the market. You want to manage a portfolio of individual stocks yourself, and you've got the emotional strength to sit through pullbacks, which are inevitable. If you don't like that, and that's completely okay. There's ASX 200 ETFs where you don't need to manage a portfolio of individual shares. But if you want to trade individual shares, you've got to be able to give them room to move and have a tolerance for that. If you don't like it, it's like you and I, we don't make the market's rules. The market plays its way, and you either play the way the market operates in and give it room to move around, or you've got to look at something else. You're just frustrating yourself otherwise and trying to kid yourself that you can get 100% plus gains with 10% stops. I wish it worked, but it doesn't.
Yeah, I think your idea about ETFs is a good one, but I think there's an itch that just can't be scratched by only trading ETFs. A lot of people do want those individual stocks. So perhaps if it's something that people are finding uncomfortable, would your advice be that perhaps they have too much money in the market because they're losing that objectivity that they're seeking? Could they team back on their amount of capital so that they could feel a little bit more steady and sure of themselves? Perhaps that would be an idea.
Well, I think this is where diversification comes in, and this is a really important thing. So, big position sizes often bring a lot of stress, and they bring risk. So, diversification, there's two sides to why diversification can be why it is, I think, a really good strategy. Firstly, it spreads risk. So there's studies I've seen where the average person might hold 3 to 4 stocks. Now, that's a highly concentrated portfolio. So if one of those stocks gets blindsided and falls 50% overnight, which does happen, and you're holding 3 stocks, you've taken a big hit. You've got a massive drawdown in one day due to that one stock. Now, I always talk about having a portfolio of at least 20 stocks. Say 20 to 40 stocks, maybe even more. I'm currently got 40 odd stocks, but I could have more than that as well. And one of the big advantages of that is that it spreads risk. So if one of my stocks goes to zero today, it's 1/40th of my portfolio. It's annoying, but it's not really that big a deal. It's not that big a hit to the portfolio. And chances of that happening are minimal anyway, but just for the point of the example, it's so if we have a wider portfolio, we reduce individual stock risk, and this is an important thing when you're trading individual companies. You've got individual stock risk as well as market risk, and the other thing that it does, and of course, diversification means also not just holding 40 gold stocks, because that's kind of all going to move as one. It's like having a number of stocks across varying sectors of the market. And then the other thing about having that wide diversification is that it increases the odds that we're going to get several of those really big trends. So remember what we looked at with the All Ordinaries, 10% of stocks are up 100%. So if you spread your risk across 20 to 40 stocks, you increase the probability that you're going to get into one of those really big trends. So I always talk about having many relatively small trades, not a few big ones. A few big ones often leads to a lot of portfolio volatility. Many relatively small trades, it just reduces that impact of volatility in any one stock and does increase that probability of getting on those big trends.
Yes, absolutely. We do have a listener question for you, Jason. I'm just going to read this one out. The Australian stock market represents approximately 2% of the entire stock market in the world. So I think we know what they mean. The Australian stock market is quite small. How can you make a living on just 2%?
There are 2,000 stocks. So all the world markets, they're fairly highly correlated. And look, good process can be taken anywhere. I focus primarily on the ASX and on the smaller end of the ASX, the small to mid-cap stocks, which might rank from, say, 300 to 600. That's typically where much of my portfolio will come from. But look, there's nothing wrong. Like the process I use, it could be used in the US, it could be used in Europe, it could be used in Asia. It's the process of buying into strength, trading with the trend, letting profits run, cutting losses, giving winners room to move, spreading risk. It's universal principle. It could be used in stocks, commodities, currencies. It doesn't just have to be ASX. I'm comfortable with mostly trading ASX, although I'll have international exposure through other means, often through ETFs. But I could do the individual stocks. I just find it easier to focus on the ASX for individual stocks. As I say, these markets are largely correlated, but absolutely, there's nothing wrong with going and finding great opportunities in other markets if you've got the means to. And if you got the means to go through and do the scans and apply your rules consistently.
The other thing I thought with that question is, because I do think that's behind some people's doubts about the Australian market, is just because we are the size we are, that doesn't predict the growth in individual stocks. So as long as you're getting into stocks that have enough liquidity so that you can get in and out, of course, easily, then be careful of making the assumption that just because we're small, there are no opportunities. There are heaps of opportunities here. We're also within the right time frame for trading, which is a big advantage. There are so many different time frames from around the world that you'd have to manipulate your own schedule to be able to really become a good trader in those time frames. Yeah, I love that.
Yeah, like my tolerance for staying up late at night and looking at markets is, it's a few decades ago. So it's. I would love to be in the US time zone for trading things like futures markets, because most of the big moves in currencies and commodities, they do happen in that time zone. But alas, I'm not in that time zone. I live in Sydney, and I can still position in currencies or in commodities if I want to, but I can't trade them the way I did when I was in my 20s. I was happy to sit up in the middle of the night and look at hourly charts and look at things on the move. But it's like, I look at my own portfolio now, and I've got I think I said 11 stocks, 11 of 42 stocks up over 100%. Do I really need to go to the US market when I can get that sort of performance locally? And it's I don't have to worry about the currency conversion when I trade in the US markets. It's like, there's nothing wrong with going to the US markets, but I don't feel I'm being left behind with the local market. It's seriously, if that many stocks which can go up triple digits, it's like, what am I trying to gain by going elsewhere? I don't know.
Yeah.
I don't know that I get a superior result.
But I don't know whether we should be chasing the superior, best possible ever result, because there are drawbacks with that. You're after the biggest results, you're going to have the biggest drawdowns most likely. It will be interesting to see what happens in the second half of 2025 when the US goes to 23-hour trading. I think that might shake a few people up. I think we also have to be careful that no matter what market we're trading, that we avoid the noise and we stick with the trend. That goes, in my terms as well, from emotional noise as well as noise on the chart. So how do you avoid that market noise and the short-term distractions that keep popping up? How do you keep your focus so that you can execute your strategy?
Look, I think there are a few parts to this. Firstly, it's like, stop looking at the constant news feed that comes through, and stop listening to all the chatter. Don't go to the chat sites. Don't constantly be watching the financial news. It's distracting. It puts ideas in your head which can take you away from your process. So that's the first thing. Just don't look at your portfolio 100 times a day. If you're trading off daily charts, don't worry about what's going on intraday. Know your levels and have your orders in, and just let it be. But also, don't overcomplicate things. I think a big problem for people with a plan is that they make their plan too complicated. I think keep it simple. Like, I look at my own process for momentum, and I'm really using 1,500-day moving averages and breakouts as two of my key guiding methods for entry signals. It's not complicated. I see people on YouTube, and I'll look at the charts they put up, and they might have 5 moving averages, and they'll have like, they'll put on some Fibonacci lines instead of the traditional 3. They'll have like 6 Fibonacci points, and they'll have a MACD, and they'll have an RSI. I don't know where to look. I've been doing this for a long time, and I don't know where to look, because every time the price moves, it hits something. So keep it simple. Just bring it back to the basics. Don't overcomplicate it. And I think simplicity. I really do think simplicity beats complexity. And if you've got a good process, if you've got a good process, I think also don't second guess it. It's a problem I think a lot of people with good process have. They second guess their systems. I know I've done it myself, and I try not to, but invariably it happens. We're all human. We're always trying to just tweak things and get it a little bit better, but we've got to be good at trusting our process more often than not. That's what we've tested. That's what we should trade. We should trade our process. And I think to do that, 2 of the really important things that we've got to have awareness, and we've got to have discipline. So we've got to have awareness when we stray from the course, when we just come off the tracks a bit and start to second guessing, start to go, oh, look, I can just tweak this a little bit. Have the awareness when we come off course, and then have the discipline to pull us back on course. And look, it's something I did I remember last year I had a buy signal for a company called Gentrack. Again, it's one of those small to mid cap stocks. It's got a market cap of $1 billion now. But I had a buy signal it was a motion trader signal. It was a signal for my own portfolio. I looked at it and thought, look, I've got to get that. But I got distracted. I was doing something else. I thought, look, this is okay. It'll probably consolidate its initial gains for a few days, and I'll have a look at it later in the week. Then it jumped 20%. And I look and go, oh, I should have just followed the signal when I had it. Why didn't I do that? And but I had the awareness to go, look, I've come off course a bit. I've got to get back on track. So I waited for the next consolidation. It came back to the moving averages, stabilized, and I got a position then. And it's now up. I think it's up close to 400%. So it's one of my best performing stocks. But it's in my portfolio now because I had the discipline to get myself back on track when I came off track a little bit. So we're all going to do it. So don't beat yourself up too much when you come off, when you stray from the tracks. But just get yourself back on and follow your process. Don't start trying to do it on the fly, because that's when things really do come unstuck.
I'd so agree. That's such an important point. To be able to recover quickly from a trading error, I think, is showing that you're maturing as a trader. So what would be the key opportunities for 2025? And then tell us how people can stay in touch with you, Jason.
Well, I think the key for 2025 is just don't have preconceived ideas about what will happen. We see it every year. 5 high conviction ideas for the next year. I roll my eyes every single time. Who's got the crystal ball to give a high conviction idea? We just don't know. Don't have these rigid ideas about what will happen, because nobody knows. As soon as I hear someone say the word will, it's like a turn off, because we don't know. Forget the word will. It's like could and might and potentially. They're the words I want to hear when I'm listening to somebody, and then I'll listen. But when they tell me something will happen, it's like really and truly. It's so don't have these preconceived ideas. What was fascinating, it was December 23. There's a big survey from all the Wall Street strategists, what's going to happen in the next year. And so this is what was going to happen in 2024. And so they surveyed about 20 of them. There's, like Goldman Sachs, Bank of America, JP Morgan, all the big names. The average forecast for 2024 was for a 1.9% gain in the S&P 500. Now, as we know, the S&P 500 was up 20-odd%. JP Morgan, they predicted a fall of a bit over 13%. Now, this is it's one of the world's biggest financial institutions. It's got some of the smartest minds, the best information. They pitched it 14% fall, and so completely wrong. Now, this isn't to put down on anyone's forecast, because forecasting is really hard. I would have got it wrong too. I would have pitched it up because the trend was up, but I wouldn't have got it right. So, and this is the thing with forecasting. Forecasting is just inherently difficult. So don't have rigid ideas about what's going to happen. Instead, I think be open-minded and follow the price action, because the price action is showing you where the money is going. If the money's going in, the trend is up, go with it. See where it goes. See where it takes you. See if it takes you to 10% or 20% or wherever it takes you. If the price is below declining moving averages, be fearful. Be concerned that my capital is in jeopardy. I need to take moves to protect that capital so that when the trend does turn back higher, I've got a good war chest. I'm ready to go both emotionally and financially. I'm not going to get myself beaten up trying to fight against the trend. So, yeah, Louise, I think it's just forget forecasting. Get good at responding to what the price action is telling you rather than trying to enforce your ideas or having a rigid idea of what's going to happen, and take the ego out of it. Who cares if you're wrong? Doesn't matter. Doesn't matter if you get it wrong. Use a stop loss. Just be wrong a little bit. Fail early, fail cheaply. That's the game. And when you're right, hit it out at the park. That's what you want. But you've got to manage risk, and you've got to be flexible and go with the price action, not with a rigid idea of what you think should be the case.
Jason, you have successfully offered our traders in the past a free course. Now, it's at motiontrader.com.au/talking trading. Jason, tell us about that free course.
Well, what that does, it's really a free trial of the whole Motion Trader process. And I've got 4 introductory videos, which really goes through the process. And the things that we've been talking about spreading risk, letting profits run, giving them room to move, cutting losses, it's all contained within the 4-part series. I think one of the most important things is, there are lots of services out there that want to tell you what to do, and that's all well and good. But I also want to. I think what's more important, actually, it's knowing how the process works. So, yes, I do the scans, I come up with the ideas, I calculate the trailing stops, but I think more importantly, I explain the process, because I think the people who do best with a service like Motion Trader are the ones who understand the process. They understand why we're using a wide trailing stop. They understand why we're letting profit run. So I explain all that, and I help them make that process their own. It's a really important part of making it work for you. So that's what people get. They come along, they sign up for this promotion, this 2-week trial I have of the service, see how it all works, get some signals, maybe learn about some stocks they've never heard of before, depending on what the market conditions are like at the time, depending on what the market gives us. It's not about you're going to get 3 buy recommendations each week. It's what does the market give us during that period? And then learn a process that you can then take away. Even if you don't come along and take up the full service, you might still learn some parts of a process, which maybe it's some of the missing pieces that maybe you got part of a process and you learn some of those missing pieces, which might make all the difference. So look, that would be great.
Absolutely. So go to motiontrader.com.au/talking trading. Jason, what a pleasure having you back on the show. No doubt we will be catching up before the end of the year on some huge yacht sailing around Sydney Harbour, because that's what I love to do with you. So thank you so much for your time. And until next week, happy trading.
That's fantastic, Louise. Thanks so much for having me on. It's been so much fun. I look forward to next time we catch up.
Fantastic.